Hello, welcome back. Let's take a look at a company that was suggested by one of our subscribers. It's WiX.com, and I have made a video about it, but it's been quite a while. So we're going to be examining it from scratch and examine the financials and see whether it actually makes sense to purchase the company right now. You will see what they're doing in the last 30 days here, but if you go back a year, you will notice that the company's stock price has been down. And if you take it even further, like 3 or 5 years or even the max, you will see that the company had a massive upturn around 2020, and then it had its down days, and it lost a lot of its value. It used to be 330 almost dollars, so it lost 71% of its stock price. And if you bought at these levels, you have been annihilated. This is why we want to examine and see whether it actually makes sense to buy right now, or, generally speaking, how the company is doing, whether they can actually reverse the situation potentially and bring back some gains here. The first thing that we're going to examine here is the core financials, the core metrics that we like to examine, because these are very, very important. The P/E ratio is actually negative, pointing to a company that is losing money. It's not making profit, it's actually losing money here. And the price to free cash flow ratio is also very high. It's not negative, but it's very, very high. We will see how they are making their free cash flow though, because when they have negative earnings and they have positive free cash flow ratio, that kind of, tingles my spidey senses. And so that probably means that something is wrong here. And we're going to examine it, taking a look at the financials later. Another bad thing, outstanding shares being higher than what they used to be, being more. So there has been some dilution, and quite some, actually. 26% in 5 years is nothing to sneeze at. That's a lot of dilution going on. Massive debt here. Look at this compared to the free cash flow. The total liabilities of the company would take about 68 years to be paid back. And that's alarming. That's very, very alarming, of course. The 5-year revenue growth is increasing, but the net income and the free cash flow growth are decreasing, and massively also. Especially the free cash flow growth over here. You'll see that it actually fell off a cliff in the last year. Now, the 5-year total equity growth has been increasing, but I'm assuming the equity comes from the outstanding shares here, from selling stock. We'll see that. We will examine that. And a massive debt to equity ratio here as well. You typically want to see this below 1. And right here we're talking about 13. So these financials, the moment I see this points to a company that has much trouble with debt, really. And this could be a very, very big problem for the company, even potentially leading to its default if things don't improve. And right now they are selling a lot of outstanding shares in order to, to get some capital. But what are they doing in terms of their operations? How are they making money? Are they really making any money? The financials here are pretty horrible. Let's take a look at the actual statements here, because that is more important. Over here we will see exactly what they're doing, and you will see that the net income is negative and keeps actually getting worse and worse and worse. A little bit better in 2021, but still much in the red. And the balance sheet of the company, I'm pretty sure we're gonna see a lot of additional paid-in capital here. If I take a look at this line, as you can understand, yeah, it's pretty much more and more shares sold every year. This is how the company funds themselves, pretty much, and this is how they have some equity. Otherwise, it would be pretty much all liabilities here. It's mostly about additional paid-in capital, and yeah, some debt as well over here. Okay. The cash flow statement is going to come up next, and it's very, very important to see what's going on here. The net cash provided by operating activities, operating cash pretty much, cash flow. You will see here that it has been going down a little bit, but it's still positive. But take a look at this. The stock-based compensation is 221 million. This is an expense for the company. It's just added back to the cash flow because it's not a cash expense. So it's basically the company is giving stock to pay their employees, and this is added back to the cash flow, making this a positive number, while practically speaking it would be a negative number. So I've mentioned this in many videos. This is something important that you need to realize, the fact that this like stock-based compensation, depreciation, amortization can be added back and will be added back to the cash flow from operating activities because it's not cash, and so it has to be adjusted. And the cash from investing activities has been positive here because they are selling investments. For the most part, they sold 1 billion. I guess they need the cash flow here. And in terms of repurchasing, they did repurchase a little bit of stock over here. I'm not sure why, but they did. And for the most part, they have been selling stuff and getting debt. Now the free cash flow again is in the negative, is not in the negative, is positive, but practically speaking, again, we examined it mostly comes from the stock-based compensation and a little bit of depreciation and amortization. It's not from the net income. As you'll see, the net income is negative here every year. So it's about pretty much adjusting for the non-cash expenses, how you're getting this positive free cash flow. Otherwise, this would be negative as well. But now let's take a little bit of a look at the stock evaluation tool and see a very, very clear overview of what the company is doing. They are increasing the revenues. That's a good thing. That's great. And so we can actually even go a little bit overboard and go like 18, 20, and 22 for the next 5 years. I wouldn't be surprised if they do that. The problem is the net income margins. Look at that. They are all negative every year. Every year they're losing money. So what can you project here? Should I project that the company makes 5, 10, and 15? That's a very, very bold assumption for the next 5 years. Massively bold assumption. I don't know if they will achieve that. But I have to go with something positive. Otherwise, we're not making any cash. And otherwise, the investment is not worth anything. It's all about the hype if the company is not making money. And the free cash flow margin, again, very, very red here. Every year is bad. I could go with something like 30, 40, and 50, which would imply that the company really turns things around and starts making net income and free cash flow, and quite some, actually. These are very, 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 very aggressive projections that will more than likely never really happen in the next 5 years. It will be very, very doubtful. And if we hit calculate even these projections, which are insanely positive here, even with these projections, we're looking at a max price to pay today that is far below our current price, which is very, very overpriced right now. And so typically over here, you would have to go much, much lower, like 1, 2, and 3 could maybe make some sense. And like, I don't know, 2, 3, and 4, a little bit more here. I mean, again, every year has been negative so far. So just going positive is a stretch already. So if we calculate with this, then you are looking at a company that is almost a penny stock right now, based on what they are doing financially. And again, you may be thinking that this is a company that could flourish in the future and make money, and that could happen. That could happen with any company, but the opposite could also happen with any company, that they go broke, or they never do well and stay at the same levels, and the company stock price goes down and down and down. So the question is, do we want to be buying a lottery ticket, or we want to be buying a company that is actually doing well already and we want to grow with them? So this is what you have to decide, because otherwise you are buying something that is a lottery ticket here. You are actually putting your marks on a company that could potentially, do well, maybe. You're betting. You're actually taking a bet here. And you're overpaying for it massively already. And even if they do well, you will have probably overpaid so much that you have paid the company like 10 or 20 times more than what it's worth right now, at least, I'd say. So you have to be really, really cautious about these companies that seem awesome just because, they have been doing perfectly amazing in the previous years. So you see them going higher and higher and higher, and now the moment they lose like 70%, you are like, okay, I need to enter here because it has lost a lot of its value and eventually it will go up, right? Now the thing is, it could happen if there is hype, but it doesn't make sense in terms of the financials. And so if that happens, it's basically hype. It's not the financials, unless something really, really changes fundamentally for the company, which doesn't look to be the case right now. So be careful about these trades. Again, for trading short term, that makes sense. You can trade the company short term and have your tight stop losses and be fine. But if you're looking to buy for the long term, this is a very, very dangerous play here. This could go down much more. I wouldn't be surprised at all. So be careful. Be careful about these kinds of companies that are not doing very well financially. And thanks again for the suggestion. I hope it helped a little bit. I have to be super objective based on what I'm seeing here. I don't have like a favorite company or a company that I dislike. It's all about companies and how they are doing financially. And what I'm seeing here, I have to be super objective, and I don't want to be hyping up things just for no reason. I mean, this is not the channel to do that. I mean, there are many channels that are doing that. I will never be doing that. Over here, it's all about actually really understanding financials and buying companies that are doing well, and not just buying the next big thing supposedly and diamond hands and all that. We are not about that here. So thank you for watching this. I hope you enjoyed. If you did, take a look at the video that I made earlier. It's about Warren Buffett. And remember to like the video and subscribe, because I will let you know how to get access in the tool very, very soon. Thanks a lot again for watching, and I'll see you soon. Bye-bye.